them up like cars and then make it into bonds. What a great idea. And the fact is there were also whistleblowers before the subprime crisis blew up, but people were not listening to those people. And I think that there are a lot of sound policy-making contributor from the business sectors, but they are not necessarily the ones who have all the resources. So institutions have government groups, what we call government departments in all the private institutions that are there to make lobbying efforts. But the government has to have civil servants who can differentiate those who are doing it for business profits and those who are trying to actually promote some kind of a balance. So I think there's a real dilemma in this world, and collusion is not necessary if systematically we all try to promote good policy. But of course, as we know, values today are quite different, and a lot of people believe that the business has captured the government in many sectors and in many countries.
What I would add is that I see a kind of blatantly biased, self-interested lobbying as one of the most important forms or sources of reputational risk for the company. So that reputation can be destroyed if the company is seen as interested only in itself, not interested in the broader welfare of society, and especially if it is offering misleading information and clearly biased advice.
I think, Harry, I would just disagree again. As I said, we always disagree on this. But I think Harry, he has the Hollywood version. There's the good people and there's the bad people. And they're in this big fight over the good of the society. But I would say that most of the time, the companies do not risk any reputation by lobbying in a very self-interested way. I'll give you an example. The reason that we actually had a subprime crisis in the United States came from more than a decade ago. There's something called the Glass-Steagall Act. Has anyone heard of it? Yes. So, Quinton, what does the Glass-Steagall Act do?
Preventing financial banking.
Exactly. And as you all know, the United States went through the Great Depression. And part of the great thing about the Great Depression was the United States says it's very dangerous to take people's deposit and to put it in risky financial products. So they had the Glass-Steagall Act, which separated banks like Citibank, Bank of America, from banks like JP Morgan or Morgan Stanley, and that's how Morgan Stanley was created, where I first worked when I graduated from college. So you can only do investment banking if you don't take people's deposit. Now, fast forward in the 90s, there was a huge effort by all the investment banks to ask for a commercial bank license. Why? Very simple. The cost of capital is very low if you take deposit. You don't need to borrow some money on such high leverage, such high interest rate. So all the investment banks put together a very big department to lobby for the government to basically take down the Glass-Steagall Act. And it worked. So the government decided to basically take this down, and what do you have? You have Merrill Lynch buying Bank of America. You have Morgan Stanley buying Dean Witter, and also going into all sorts of other activities. And of course, we know what happens. More and more, basically, financial institutions in the United States basically are mammoth, and they cross both investments and commercial banks. Now, did any institution get blamed for lobbying to take down the Glass-Steagall Act? No, because it was an industry effort, and the government decided to do it.
Industry suffered a collective
But
reputation.
did it cost anything? I would say no.
Cost higher regulation than one
Yeah, but all those people who needed to make the profit already left and retired and became government officials. And so my contention, Harry and I, as I said, see the movie in a different way. I see the movie as having a sequel. He says, no, we're still in the movie. It hasn't ended. They're having a collective punishment. I say, no, I think those people are retired and went home. And you know, this generation doesn't get the same kind of profit margin. So I think that we still have but you know, this will make me sound like a Marxist. Essentially, we have the destruction of capitalism sort of embedded in this the way that it's systematically being executed in the real world. But I will let Harry have the last word.
I already did. All right, any more questions?
Okay, because the time constraint can accept two more, but not too long questions, short questions. Okay.
I tried, I don't know. I just wonder if there's like a certain pattern you can observe. I mean, yeah, you've been studying it for a long time, because if companies are first trying to lobby until a certain threshold, and then they realize, okay, I can't change this government policy, now I need to react. And if it's so, maybe like how much time they have left, or like how immediate is the reaction. Because for one example, I just read today in the newspaper, a German company, E.ON, they're getting rid of their nuclear plants as well as their coal plants. And this was one of their major businesses. And like the policy leading to that action had been taken into place for 14 years, like since 14 years. And so I wonder, like, how long had they been trying to kind of turn this policy around and then took action, because this is like, immediate last minute action they take.
Really collect two questions together.
Okay.
It's a bit different, but was to your life without the discussion yet. Just, I think when we consider outcomes, it depends on the benefits or advantage or disadvantage, depending on the time frame you're taking. So, is the deregulation has been good or bad? I think the answer mainly depends on which time frame. So, to compare a position today and compared to what the world was back in that time, are we better, are we worse? I think we're still better now than we were a few years ago. But on a short time frame, are we better now than 5 or 7 years ago? Then that's another story.
Shirley has handed me the microphone, which I think is my license to speak. You put your finger on an absolutely fundamental question, and that is basically the relationship between forecasting and prediction on the one hand and policy analysis on the other. The basic tool of public policy analysis is called either cost-benefit or cost-effectiveness analysis, depending on what you're looking at. And the question that you ask is, when do you know? How long does it take to come to a conclusion? And depending on the issue and the policy, it may take a very, very long time. So in other words, it may take a long time for us even to know whether the decision that was made 5, 10, 15, 20 years ago was the best decision or not. And of course, knowing what the alternative decision might have been complicates it more. But then if you flip it around and say we're making policy now, and then you have to predict the outcomes of your policy for 5, 10, 15, 20 years, depending on your time frame. You see how complicated policy analysis is. One of the things that concerns me most about how public policy is taught and how it's conceptualized is how little forecasting comes into the picture. That basically the assumption is that we know what those costs and benefits will be, and then we can calculate the comparative advantages and disadvantages of alternative policies. This is all a matter of forecasting. And as all forecasting, it has to be probabilistic, it has to be contingent, and then you have to deal with the question of how do you manage the remaining uncertainties. What happens when the policy begins to fail? Have you anticipated A, that it might, how it might, and what you will do if it does? And these are very, very rarely parts of policy analysis, at least as I've seen it as being the dean of a school of public policy. So I guess the main conclusion that I would leave with you is how important forecasting and foresight is in any kind of leadership position. The difference very basically is that forecasting is sort of standing where you are now and looking forward, what's going to happen. Foresight is trying to anticipate where you will be in the future, and then the decisions that you will have to make, and then work backwards to how you're going to prepare to manage those things successfully. It is fiendishly difficult. First question, which was remind me. But the nuclear plant, I don't know the issue. So I think that you raised the right question, and that is how did they see what was coming? And you said they were backing out not only from nuclear but also from coal. So the question is, and that's one of the main differences in clients we found was time perspective. And basically, asset managers, most of them, have a time perspective of about 1 or 2 days. They're trading like this, maybe 1-2 days is long. Their time perspective is really short. Doesn't make it necessarily easier to help them because the uncertainties are great, but the time perspective is really short. For those making capital investments, some of those investments are a huge time frame. I don't know about power generation, which is I think what you're talking about, but I know that the longest time frames we were thinking about in dealing with clients were for oil companies who are making huge investments in exploration and then in production in usually quite problematic parts of the world, and then the weapons industry, because the time frames on weapons design, on threat identification, weapons development, procurement, deployment, these are also enormous. So different sectors, different groups of clients have different time frames, and I'm sure that the power generation one is towards the long end of that particular scale, and all I can say is I sympathize with your problem. Identifying those kinds of risks over that kind of time frame, very good.
Of course, as usually the case, I have different answers than Harry. So I would say that Clinton's question I read in a different way because he's asking a political economy question, but Harry answered it in terms of a business user of data, of political risk. And I would not say that I agree with the time frame issue. Glass-Steagall Act, you're right. And I would agree with your question or observation, which is Glass-Steagall Act was formulated in the 1930s for a different societal problem, which was the Great Depression. Everyone was so poor, they couldn't eat, and so we needed some law to kind of prevent that kind of societal risk. Today's world's biggest problem in the United States, in Taiwan, in Japan, in Korea, the list goes on, is inequality. And so for the sort of post-development societies, the economic problem of all these national government is not GDP growth or coming out of a depression. And therefore, the sort of taking out the Glass-Steagall Act really ignores societal sort of goals. And I think that this is one of the problems when we talk about, Harry talks about, whenever he talks about analyzing political risk, I think there's a lot of it because his clientele were asset managers, which I really was myself. As an asset manager, as a private investor, you can have, if you're a trader, my brother runs a hedge fund in New York, his time frame is 5 hours. He does short and long, he does derivatives, long, short, day trading, and he has 5-hour time frames. Some of them he holds for 5 months, but to me, they're all extremely short. As a private equity investor, venture capitalist, my time frame is 7 years. And so I know the difference in that. But the most important part about political risk analysis is I have never seen any business decision maker actually take the quantifiable risk and put it into their model. So when we used to invest in, for example, years ago when we tried to invest in Myanmar, it was still, of course, run by the military. And so did we really sit down and write down the risk, sort of ratio? No. We sat around the table and we said, who are the smartest people in the world we can call about Myanmar? And then we called them. We paid and we called them and we said, what do you think? And then we basically, I say that investment is so much more of an art than observers think. It's all art. And traders even more. They take the number and they take it, they think about it, they say, fine. Investing in Tencent has regulatory risk. It's a gaming company in China. It's listed in Hong Kong. What's the risk? And they decide because their fund allows them to invest in this market, how many percentage they'll do it. But I don't think that people really quantify it in the way that you understand it in a model. And so that's why the economists have not been very helpful in most of these situations and in predicting crises. So the second part about the nuclear issue, I think, is the same. What is the societal goal? And the societal goals have been changing so much. And this weekend, we feel so strongly about it. Yesterday, I was just talking to Jerry about why young people in Taiwan are voting in such huge number. The turnout of young people in this weekend's vote was so big compared to the past. And therefore, you have to factor that into the political risk that the national goals will reflect younger people's goals. And so that it's not what Harry and I say anymore, we're of a different generation. And so I think a lot of people are worried about inequality, and the policies have to respond to it, not just to what we consider to be economic problem, which I think that a lot of traditional business people go for shareholders' value. National politicians are competitive in the political field with, I think, the wrong ideas in mind. And that's what's happening, I think, with a lot of the mistakes in policies.
I talked earlier about drivers, and I'm convinced that one of the biggest drivers, and in fact the one whose contours are most predictable, is generational change. Demographic drivers are the easiest to predict, unless there is a huge catastrophe, nuclear war, a plague. You pretty much know what the age structure of a society is going to be 5, 10, 15, even longer turns out. We know there is a generational change. Generational changes occur all the time. We know that there is a new generation rising. What we don't know clearly is the so what question, what the implications of that are going to be. But my instinct is it is going to be profound. It's profound in the United States. It's beginning to be profound in Taiwan. It's going to be profound in mainland China. It's profound in Europe. And I think that there's a good example of trying to come to grips with the meaning of the drive, not just that it's going to happen, but what's it going to mean. Then it gets interesting when you start talking about the intersection of drivers, say the rise of social media, with that technology, intersecting with the emergence of a new generation, intersecting with global trends towards greater inequality. How do these all fit together? And do they all point in the same direction, and do they produce alternative scenarios?
Okay, I think it's really enjoyable 2 hours of learning, and we really broaden our horizon. Actually, this is really the goal of our class, to incorporate more comprehensive factors into our analysis, not just for the business operation, but for the great picture of political, economic, and social developments in the context of global settings. So my understanding is that just because of this class, Professor Harding, Professor Lin rescheduled their flight and paid a fine. So we really appreciate their inputs and their presentation in this class. Let us give a warm applause. Okay, thank you very much. It's a